Hello, everyone. It's Andrew Fee, the Yankee closer from Crumpin Community Mortgage. Today is Monday, January the 10th, and the buzzword that you're hearing in the street today is fear. Yes, fear of rising rates. Let's all try to combat that and help potential buyers understand that the realization that, yes, rates are moving higher, but the reality is that you have to take all of these things into perspective. And we may have thought that after Friday's unemployment numbers came out, you would think that, wow, rates should be dropping because the numbers were weaker than expected. However, the inflationary component of those numbers, average weekly and hourly earnings, spiked again. Again, more difficult to keep people working within a specific company. And those people that are working there are actually getting higher wages, which is inflationary for everything as we move forward. So what we're going to do is we're going to take a look at something. And I want you all to use this as a very good benchmark. We used it within our company. Don't get caught up on posts that rates are higher, and don't get caught up on what the media is saying about how home prices are unaffordable. We're going to conquer that affordability myth in another video tomorrow. But let's take a look at this, because this is the perspective that we all need to put our heads around, okay? So if you had a loan amount, not a debt purchase price, a loan amount of $300,000, we're just going to look at principal and interest only. So from 3%, where we were towards the end of last year, maybe towards the end of October, November, principal and interest payment was $1,265. As we ratchet up a quarter of a point, all the way up to today's number of approximately 3.75, we're looking at a difference between the lows of 3% that we saw a few months ago to $1,390 a month, which is only $125 per month difference. Now, over the long haul of the loan in 30 years, if you look at the amount of interest you're going to pay, well, it's not going to be that pretty, but let's all be realistic. People stay in homes anywhere between 5 to 7 years. And who knows, there might be a refinance cycle that might be circling around if indeed we get into a recession starting next year. So the reality is that, yes, a mortgage payment is going to be higher, but it's not that bad. You figure out what you do for $125. Is it a night out eating? Is it one less pair of shoes that you're going to buy? Whatever it might be that is a component of your monthly budget, just think about that. To get into a house, to take advantage of home ownership right now. And again, home prices are continuing to appreciate. They may not be at the highest levels that we've seen in the last couple of years, but they will continue to go higher as demand continues to be extremely strong. If you have any thoughts about this, please let me know. I'd love to talk about it. Affordability is something we need to talk about tomorrow, though, because I think that's also a myth that's out there, and I think that's also potentially scaring your buyers and my clients. Let's combat it together. Love to hear your thoughts. Have a great day. We'll talk soon. Bye-bye.